Well, hi there, it's Adam again. Thanks so much for joining me in this series of Real Estate Investing Explained. You can find out more about that at leadersofthecrowd.com/small change. Now, today what I'm going to be going through is the concept of diversification. In the first instant, the way that people think about diversification is to invest in what have traditionally been called alternative investments, and that includes real estate, away from stocks and bonds. So once you make the decision to invest in real estate, you've diversified away from stocks and bonds, for example. However, even inside real estate, you can diversify, obviously, right? If you invest all your money in one particular project, then you have a concentration in that project. If you decide to diversify, and by diversifying, what you're doing essentially is spreading risk across a variety of different investments. If you do that in real estate, then you can diversify across geographical areas, across different developers, across different types of real estate, etc. So let's take a quick look over here at the Small Change website. And I've picked it looks like 5 different projects. So here is the Marlboro Pike project, right? And this one actually is a full cycle project. And you can see, first of all, this one was in Washington, D.C. And in fact, this one returned 17%. So this was 10% per year, but it's a Washington, D.C. project. Then we'll take a look at Benning. And actually, this one is also in Washington, D.C., but it's a very different kind of project to Marlboro Pike, which was a residential project. Benning is a retail project, right? A food and retail project. And here, this is a little bit different. This is not a full cycle project. So what at the time of recording, right, today, this one has a projected return. So here, if you invest $1,000, it is expected returns are $2,030 during the life of the project, right? Then the next one is Gower Labs. Gower Labs is in Philadelphia, right? So now you're migrating over to a different location and a different asset class. This one is a planned mixed use development in an opportunity zone. And here the offering highlights are that if you invest $1,000 here, then expected back, in other words, a projection, you may lose your investment. Don't forget, here is $3,096 over the term of the investment. The next one is Liberty Bank Building. This one is in Pittsburgh. So now this is the 3rd location, right? The 4th sponsor and the 4th type of real estate. This one was projected to be and actually became a flagship beauty shop location, right? In this one particular building. So very, very different kind. It's actually a historic building, very different kind of investment. And here investors received back $5,750 for their $5,000 investment. And the last one over here, this one is in Chicago. So now this is the 4th location, the 5th sponsor. And over here, this one has a projected return of $2,050 against a $1,000 investment. Again, these are projections and you could lose all your investment. So there are 5 projects that you could invest a small amount in each, right? Instead of concentrating your real estate investing into a single project, you can invest across a range of projects. And in this case, the examples I've shown you today include residential, mixed use, retail, and industrial. All right, plus in different locations and with different sponsors. So that's the concept of diversification. Don't put all your eggs in one basket. Do remember that there's a lot of work involved in researching these projects. You can lose your investment, right? No matter how well you diversify. But if you want to find out more about real estate investing, do go to leadersofthecrowd.com/small change, where you will get access to some very detailed training. Thanks so much for joining me today. I'm Adam Gower. I'll see you next time.